Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me on Earth Day, we have Maggie Peloso, partner at Vinson and Elkins, and Evan Harvey, global head of sustainability at Nasdaq, to discuss U.S. climate change disclosure regulation amid a flurry of SEC ESG related developments. Maggie, Evan, it's great to meet with you. Welcome to Trade Talks. And Maggie, I'd like to kick it off with you. Explain to us why the SEC is making an aggressive push now and what developments issuers and investors should be aware of.
Well, Jill, thanks for having me, and happy Earth Day. As we all know, there's been quite a flurry of activity of late. The Biden administration signaled even before the election was over that corporate disclosures around ESG, climate, and sustainability were an issue that would be a priority for them. We had seen in the past 4 years a proliferation of interest in this space, and some questions about whether companies and investment advisory firms were really following through on the kinds of promises they were making. And I think here the SEC sees themselves as an important part of moving the Biden administration's climate agenda forward, and doing that by increasing market transparency. So the really big things that are going on right now are, of course, the SEC has opened a comment period seeking input on how they might move forward with regulating climate disclosures here in the US. So should it be Regulation SK, Regulation SX, or something entirely new, which is a really interesting concept to consider when you think about the broad array of types of data that you need to really meaningfully assess climate risk and address climate disclosures. And then most recently, the SEC's examinations division, which has included climate in their examination priorities for this year, issued a risk alert in which they said that ESG fund advisors really need to be ready to increase their level of transparency around what they're doing in the ESG space, and to make sure that investors are not being misled by what they're doing.
And Evan, part of the challenge with climate change disclosure and ESG overall is a lack of standardized reporting processes. Are you seeing any improvements in there?
We're seeing attempts. We're seeing an attempt at conversion among many of the major ESG reporting frameworks, such as GRI and SASB and TCFD. I think that the engagement that we're seeing from the SEC on this topic is in particular related to a lot of advocacy around climate disclosure. So TCFD in particular and others have sort of focused on corporate disclosure when it comes to shared responsibility for climate issues and consumption and energy strategy going forward. But it is a problem, Jill. You make a good point. There is no consistent gold standard around the world for ESG transmission or disclosure. There are a number of frameworks, rankers, raters, firms that are evaluating corporate performance when it comes to ESG, and no two of them perfectly agree on which metrics are the most salient.
And Maggie, how do you advise clients when it comes to reporting?
So I think Evan's point about the lack of consistency in ESG reporting frameworks is a salient one, and I'm particularly glad he raised TCFD. We're seeing TCFD emerge as a bit more of a global standard. It's increasingly required by regulators in Europe and in the UK, but it remains a bit of a choose your own adventure kind of moment, right? That even within the TCFD framework, you have the pillars upon which companies are meant to report, but they retain a lot of discretion in what they can and do report. So there's been a lot of good work done by a variety of NGOs and by the TCFD itself in looking at how even once you're within that framework, there's still quite a lot of variation in what companies are reporting. So as we advise clients, I think there are a couple of different things that matter. And one is sort of what do you know now? And the other is how do you look around the corner, right? And I think I'll start with the looking around the corner piece. It's very clear that the SEC wants to be in a world where there's more standardization and where things are more data driven, which brings us back to the question of where are we now, right? And I think one of the reasons that you see so much variation in what corporates in particular are reporting is because they're in a lot of very different positions around what data they actually have and what they know, and in the level of rigor that they're able to apply in thinking about things like forward-looking climate scenario analyses, right? Because to do a good scenario analysis, you need to know not only, what are your emissions now, what are the sectors you're in that are exposed, but then you've got to go out and you've got to rely on forward-looking projections of demand, forward-looking projections of what's the world going to look like. Are your sites going to go underwater? Is it going to be too hot for your power plants to run efficiently, right? Things that are getting better defined in the climate risk modeling community, but then you have to translate them over into thinking about what that means for the actual impacts to your corporation. So as we advise, what we are really doing is pushing for a two-pronged strategy with a lot of our clients. And the first is to be very clear about what you do and don't know, and make sure that you're being really transparent about what risks you can cabin. And then the second is to think about what is your duty to enhance the quality of information and enhance information transparency going forward, right? So if you're saying, I can't disclose that because precipitation is not as strongly attributable to climate as some other things when you look at things like the National Academies report. So maybe it'll be really worse for me if there's a ton more monsoon events, but I can't tell you that. Do you then have some kind of an obligation to go out and start to think about, well, what are the gaps in that science as it applies to me and my facilities, and how do I need to participate in the dialogue to move that forward?
Right, and of course, Evan, all comes down to being able to quantify this for an investment. And my second question to you is, what's the time frame?
Well, we're certainly running out of time. There's a sense of urgency around climate and some other issues in particular. And, we thought we had more time to plan for pandemics, and look what the last 18 months has done for us. So there's certainly a lot of global issues that are pressing this issue forward, not just economic issues, but issues that are related to climate and the trickle-down effects of climate across the globe. So climate-related immigration and social scarcity and availability of jobs and the dislocation of labor, a lot of things that have come up in the last year and a half. And I think that Maggie did a really great job of summarizing where we are in terms of corporate disclosure and the sort of need for more transparent and more meaningful data. And I love the fact that the article that she just published at CorpGov focuses on point one being organize your data, start to look at your performance metrics in terms of numbers and try to find the numbers that are meaningful to transmit outside of the company, because we have moved well beyond the point of PR and marketing around corporate sustainability disclosure. We're now into a data-centric era, and that data itself needs to become much more disciplined in terms of its rigor and its measurement and its uptake around the world.
And Maggie, you mentioned something about finance emissions. Can you tell us more about that?
Sure. So there are increasing movements as the major US banks and major global banks have made their own climate change commitments to quantify the emissions that result from the activities that they finance. So it's a concept they call financed emissions. So this is basically, what's the scope 3 greenhouse gas emissions from your lending activities? When you step back and think about that, that's an incredibly hard exercise to go through, right? Because what you're asking a bank to do is to essentially look through its loan book and try to understand what the dollars are going to and what the emissions are. And then if you're really getting down to, well, what does that mean about opportunities to improve, right? Then you're starting to ask, does that mean you're going to lend to different things? Are you going to try to get the companies you're lending to behave in a different way? And the big thing to watch in that space is a group called PCAF, the Partnership for Carbon Accounting Financials, which now has a bunch of US banks as members and seems to be one of the real places that will be a locus for activity as the banks try to figure out how to make good on their commitments. If you actually go back and look at what most of the banks have said as they've made their net zero pledges, they have said, and guess what? The first step in that is we're going to figure out how to quantify these financed emissions so we can tell you where we're starting from.
Yeah, Evan, I guess that's what the challenge is. It still sounds very arbitrary in my mind.
It could be, but I think that there are emerging standards that are helping to coalesce the discussion around things other than just corporate disclosure, other than just investor demand. So we're seeing it, as Maggie just mentioned, creep into areas of measurement that have traditionally been left out of the sustainability argument. We're seeing it also in terms of financial instrumentation. We're seeing it not only from the regulators, but we're seeing it from the product creators and the index makers and the ETF makers around the world. So I think that people are trying to bake in ESG signals and data into all of their engagement with the market space, especially the capital market space, but also increasingly looking at the capital markets as a solution to some of these pandemic or these systemic problems around the world, more so than just a opportunistic market choice.
That's a good point. And Maggie, I'd like to ask you for any final thoughts here.
So I think that as we think about standardization of disclosures and increasing data, it is also important to think about what we lose by getting too standardized. And I will speak specifically here about physical climate risk, because that is the area from which I come, right? There is a huge need for the markets to have clear, transparent data that allows for investors to compare, to measure corporate performance against ESG performance. But I think it's also important to not lose sight of the fact that one of the really powerful things that ESG can do for companies is be a tool for imagination, right? You know, a year and a half ago, if we were sitting here and you had gone to a big energy company and said, hey, guess what? I need you to think about what it would look like to have a global pandemic and OPEC plus falling apart at the same time, they would have told you were crazy. As it turns out, we did have one client who had run a pandemic scenario beforehand, and they were a little bit more ready than others. And so I think that as we think about responding to the needs of investors and others in streamlining and putting numbers behind everything and being more quantitative, which is all going to be a very important part of this conversation, we need to also not lose sight of the fact that ESG also needs to be a place where we have exercises of imagination and where companies are thinking more broadly about the suite of emerging and non-financial risks they might face and how to manage them.
That is an excellent point. And Evan, we'll give you the last word here.
I think that Maggie's right. For a long time, we've thought about this as a risk management exercise or as a potential innovation and product creation exercise. But I think that people are seeing both sides of that now. And I think that the data is only going to make that process stronger. So I think that as we have more consensus around the data that we use to measure and create insight around valuation over time, especially in these financial instruments that we've been talking about and in capital creation, then I think that we'll see the risk management side develop as a pace with the innovation and product side. So there's opportunities in both.
Maggie, Evan, happy Earth Day. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.